We do, or enough. Morning, everybody. How's everybody doing? Wow, glad to hear it. Well, thank you for such a nice introduction. We got a great panel here for you guys today. Why don't I just jump right in here? So it's been a year of disruption for the global monetary system as well as for world currencies. How will things unfold from here? Will things equilibrate in 2023, or are we witnessing a permanent shakeup of the monetary order? Perhaps most important, which forms of money will best protect our purchasing power through what lies ahead? Big questions such as these require big minds to divine the answers. We have a superstar panel of such big minds assembled here for you today. So let me get started introducing them. First, we have Danielle DiMartino Booth, former advisor to the Dallas Fed, CEO and chief strategist for Quill Intelligence, and author of the book Fed Up. Danielle? So a round of applause. We're also joined by Russ Gray, co-host of the Real Estate Guys Media Empire and educator on real estate investors to more people in this room than I believe I can count. Russ, come on, join us. See you, brother.
Thanks, buddy.
And we may be joined by one or two other panelists.
I'm over here.
Bit of a late night last night for several people, so they might be straggling in as we come along here, and we're just gonna roll with it. All right, folks, lots to talk about here. We'll keep this really conversational, so I'm gonna toss questions out there, obviously, but if you wanna riff off of each other's answers, you wanna take things in a different direction that's more interesting to you, you've got total carte blanche to do that. But let's jump right in here. Okay, so the inflation-deflation debate has been a perennial one at this conference. But there's no question that hot inflation has been the biggest driver of monetary policy by far over the past year. How long will it persist, and how far will the central banks have to go to tame it? Those are big questions right now. I'd like to get your perspective on those questions, but I want to get that by asking you to react to this clip of a discussion that I just recorded with famed macro forecaster Dr. Mark Faber. Jens, will you play the clip?
We are in a situation where the Fed needs to hit the financial system straight into the face with a fist to show them the resolution of fighting inflation. And otherwise, if they don't do that, well, then inflation will structurally continue to accelerate.
Okay, hopefully you guys could hear that, but that was basically Mark saying, look, the Fed has to be really tough with the financial system right now and showing them how committed it is to stopping inflation. Basically, it's got to do what Powell's saying he's going to do, or else if they pivot too early, inflation's just going to persist and we're going to be potentially stuck in a easing, tightening cycle like we were in the 70s. So back to the key questions. How long do you think inflation will persist here? Will the central banks be able to bring it down? And how extreme are those measures going to have to be? How much, in Jerome Powell's world, how much pain will we have to take to get inflation under control if the central banks can bring it under control? Danielle, let's start with you because you live and breathe this question.
So I'm going to give you a very cryptic answer, very cryptic. I think that the Fed is going to use history as a shield to tighten for longer and to a deeper extent than what is required by a slowing economy. So I think they're going to hide behind the examples, the historic examples of Arthur Burns and even Paul Volcker blinked and stepped back from tightening and was forced to go back into the market and re-tighten anew. I think they're going to use these examples of history because I think that Powell potentially, maybe because he's worth $150 million and does not need the Fed's pension, I think he might be there to serve a greater purpose. And if you want for the tail to stop wagging the dog, if you want for investors to stop dictating monetary policy, then the most direct route would be to break the Fed put. And you and I have spoken about this.
Right.
There was a nascent, yay, let's break the Fed put.
So let me ask you a follow-up, and then Russ, I'll let you run. So, a lot of people are saying, okay, yeah, the Fed, and it tends to use lagging indicators, and it's sort of using those right now as a justification to keep tightening, right? Oh, okay, CPI just came in real hot, but jobs market's still robust and all that stuff. And we know there's a deteriorating environment right now in employment because those job numbers it's old data.
Well, we're not seeing it, right? I mean, I'm going to interrupt you for a minute. I've never done that, Adam.
Yeah.
We're not seeing it because typical layoff cycles begin with the lowest income earners who would immediately run out to file for unemployment insurance. And what we're seeing now is that the unemployment cycle, the labor layoff cycle, is starting at the top of the income ladder. And companies are announcing one after another, multiple billions of dollars of we're going to write it off as a one-time expense for these massive severance packages that are being paid out. And that's why this is not the normal pattern that we see in a layoff cycle, and nor do these people who are getting tons of money, nor are they rushing out to get state unemployment insurance.
Right. And, layoffs that's the last resource of these companies. They start with the hiring freezes. They start with the bonus cuts and things like that.
Amazon.com announced that the 10,000 job openings that it had were going to be frozen solid. They put it in a footnote in the announcement that said that they were going to hire 100,000 seasonal workers. They said, oh, by the way, for people we pay a lot of money, those jobs are gone.
Right. But anyway, so they're using this lagging data to indicate or to justify why they need to keep tightening, will keep tightening. So the question is the big question at this point is we know the Fed wants to tighten higher for longer, for as much as it can get away with, but then there's the whole question of financial instability, right? And so it raises the question of, can the Fed tighten for as high as it wants, or is some bit of financial instability going to force its hand? And we've just seen a preview in the UK, right, of a central bank that was literally just going to start tightening, that basically had to reverse policy because of the market revolting here, right? So let's earmark that question. Russ, I'll let you jump in, but I do want to get to the question of will the Fed be successful in tightening inflation, or are market events or some other sort of crisis going to force it to go the other direction? But let's start with you there, Russ.
Okay, so first of all, it's totally intimidating to be on the panel with this brilliant lady.
Oh,
I sat on a panel with her in June, and I sat on a panel here at New Orleans.
You're the one drinking caffeine.
Yeah, I'm drinking caffeine to keep up with you. But I'm a Main Street guy, and I said last year that I felt like the big danger was how much debt there is in the system. And as a real estate investor, I understand the inverse relationship between the price of a building, an apartment, let's say, and its cap rate. It's the same thing. It's when cap rates go up, the value drops. The bond market works the same way. So when interest rates go up, bond values drop, and these balance sheets are just loaded up with these levered bonds. And so when the Fed raises the interest rates, they're destroying balance sheets, and that's the Bank of England. So for those of you that didn't, heard that and what does that mean? That's what that means. Okay, and that's the same thing that happened in 2008. The subprime mortgage crisis created a decline in the value of certain number of bonds, and nobody knew how bad it could be because they didn't know how levered those bonds were through derivatives. That's when we found out how deep those tentacles went. So you opened up asking about inflation versus deflation. I think we're having both right now. You're having asset price deflation for the exact reason I just described, and you're having Main Street inflation. And so it's Main Street inflation where the voters are pissed and really feeling it that the Fed is trying to contain. You look at history and what Volcker had to do to break that kind. He had to take interest rates up to an unbelievable level. So the next question is, can the Fed do that? I asked Danielle last year, can they do, I asked you on the panel, I said, are they going to continue to raise rates until something breaks? Yeah. You've heard that. And then the next question is, what's going to break? And you answered without hesitation, the credit markets. And that's the bond market will blow up. That is the credit market. And so I kind of have a question for her to take it off in a little bit of a tangent. But I
We
see
like
that,
tangents.
well, the repo market's
Makes
got
my job easy.
the repo market's got 2.4 trillion in it right now. And
The
so
reverse repo facility
yeah. So
at the Federal Reserve. So money market funds are not, they're not rushing into Treasury bills, even though short rates are rising to the extent they are, because there's something that is even more risk-free than a Treasury bill, and that's this facility that the Federal Reserve has set up for these money market funds to get 3.05% in overnight.
Right,
which
right.
they
So that's why
continuously
your
do every
banks,
day.
that's why your banks don't want you to keep your money in a checking account or a savings account. They try to encourage you to go into a money market account because deposits in a bank are a liability to the bank, and they need to convert it into an asset. And so they use that money to purchase these T-bills and put them on. But when they need liquidity, they have to go back into the repo market and raise the cash.
Yep.
And so the next question is, we have a strong dollar. Mark Scouse and I went back and forth on this the other day, and I have a theory, and I want to run this by you, that there's nothing about the economy, I think, that says, oh, the dollar should be strong, right? So to me, it's like the reason the dollar is strong is because there's a huge demand for dollars, and it begs the question, what's the demand for dollars? I think it's margin calls on the bond portfolios that are collapsing. That's my theory. What do you think?
So there are two distinct, I'm going to sound like an economist, and I apologize in advance. So there are endogenous factors to the domestic U.S. economy. There are exogenous factors. Both of which are pulling on the dollar. So Nick Timmerose, the mole at the Fed, was tweeting yesterday about the Swiss National Bank pulling down on its swap lines that are set up at the New York Federal Reserve. That's telling you that not just one Swiss bank, because the number went up from 1 week to the next, but it's telling you that there is stress in the global financial system.
Stress meaning a demand for dollars.
Yeah, whenever I say stress, think demand for dollars. Because you've watched what's happened to the yen. You've watched the Japanese authorities try and defend that currency. At the same time, they're conducting quantitative easing. You've seen what happened with British pound sterling, and now you see that the euro is around parity with the dollar. I was in Geneva just a few days ago, and I took advantage of that strong dollar and got some shoes.
And they're lovely, by the way.
Well, no, not these. No, they're later this afternoon. But there is great demand for the dollar. We don't realize that the frontier markets, you wake up one day and you're like, what do you mean Sri Lanka's going bankrupt? Well, you know, in the heyday that we've had, a lot of markets, a lot of countries on a sovereign level have been able to access dollar funding. A lot of banks now rely more on dollar funding. A lot of corporations, non-financial corporations, globally, they rely on the dollar funding market. So even though you're like, well, the United States, economy's in the pisser, why is the dollar so strong? A lot of it has to do with how weak the rest of the world is, because the borrowing binge has been global. I think if Elon Musk could float a bond on Mars, somebody would buy it.
So for the real estate investors in the room, what I think you're saying is that the United States has lent money or dollar-denominated debt has proliferated all around the world.
Yep.
And just like the petrodollar, when they created the petrodollar system and they negotiated with Saudi Arabia, said, hey, all oil has got to be denominated in dollars, you suck up a lot of excess dollars. And so if you want to create demand for your currency, you have to create people that need it. How do you do that? Well, you tax people in dollars, and you have to earn dollars in order to pay those taxes, right? So that's a way. The other way is the petrodollar. You denominate oil trade, and the oil producers have been trying to get out of that system, Russia kind of leading that charge. So that's another way. But the other way is you make loans. And so when you make loans all over the world and people owe interest in dollars, they must buy dollars. And so when that much debt has proliferated around the world, it's critical that these people get dollars. And so that creates a bid on dollars. And because we got record debt, it's no surprise we have record demand for dollars. And it gives the Fed the ability to print a lot of dollars and not have so much inflation hit home. Now, it goes one more step. And if I say something wrong, straighten me out, okay?
Yep.
All right, but if if the United States were to lose its status as the world's reserve currency, then the whole world who's holding dollars in reserve don't need them anymore, and the only place they're good would be here. And wouldn't all those dollars come back here, and then,
In theory, but you're talking about like global Armageddon.
Well, it's the future of money. We're here talking about the future of money.
well.
So is that a possibility? I mean,
Might need something stronger than coffee at this point.
any Bloody Marys back in the waiting room?
No, and I mean, there is something to be said also about the other side of the coin. You asked me about the reverse repo facility,
Yeah.
$2.4, $2.5 trillion, whatever it is. The Fed did not plan on this. They planned on rising rates, attracting money market funds into Treasury bills.
Right.
Now that they have this massive increase in this facility that they did not plan on, the reserves are being drained from the banking system much more rapidly than what they had anticipated.
So people are preferring dollars over T-bills. Is that what you're
People are
saying?
preferring the Fed's facility, which is the ultimate risk-free facility, over T-bills.
Okay.
But what this means is that the bank's depletion, remember, quantitative tightening is going on in the background. And if you broaden out to the rest of the world, $95 billion a month here, $750 billion a month total. All central banks are pulling this liquidity from the system. And what this means is that banks' ability to offer leverage for commercial mortgage-backed securities is vaporizing into thin air.
Right.
Okay, so now translate to Main Street because it makes it harder to borrow.
And that answers your
And
question.
you see the mortgage
Harder and more
companies
expensive,
laying
exactly.
people off and backing up. So that's why I've been encouraging people for the last year, get into as much debt as you can, because you're going to be happy you have cheap debt long term if you've bought productive assets with it. But
Great. And just for the audience, the market of dollars outside of the U.S., all that dollar-denominated debt, that pool of dollars is actually substantially larger than the supply of dollars inside the U.S., and that system's called the euro dollar system.
Yep.
It's not Europe-specific. It's not really well named.
It was terribly named. I
Yeah.
mean, they named it really badly.
Yeah, but just think of it as all the dollars outside of the U.S. All right, so a couple of quick questions, big topics, but first is, if you had to make a call right now, and I know I'm asking you just to prognosticate here, what do you think is more likely? Does the Fed actually get inflation under control in the way that it's hoping to, or does something break first and force it to pivot?
Well, that's a great question as we sit around talking about Swiss banks pulling billions of dollars down on swap lines. And right now, it feels like we're in a game of which comes first. But Jay Powell has license right now to plow ahead for another few months. And the thing that keeps me up at night, and there'll be slides later on today when I speak close to 2 o'clock, whenever it is, the obvious things, credit spreads, they're fairly well behaved. And they continue to suggest that nothing is breaking yet, but there are other indicators that suggest that a credit event is brewing, and that will stay Jay Powell's hand. So, but when is systemic risk going to erupt? I mean, you and I could go retire somewhere, Adam, if I could answer that question.
Yeah, but that is the question right now.
Oh,
right?
absolutely. And there are many things that are suggesting that it is brewing.
So to that point, let me just read you this quote that appeared in Bloomberg the other day, talking about the U.S. Treasury market and a brewing crisis there. The word crisis is not hyperbole. Liquidity is quickly evaporating. Volatility is soaring. Once unthinkable, even demand at the government's debt auctions is becoming a concern. Conditions are so worrisome that Treasury Secretary Janet Yellen took the unusual step Wednesday of expressing concern about a potential breakdown in trading, saying after a speech in Washington that her department is, quote, worried about a loss of adequate liquidity in the $23.7 trillion market for U.S. government securities. Make no mistake, if the Treasury market seizes up, the global economy and financial system will have much bigger problems than elevated inflation. So if you can, talk for a moment about how bad, nuclear perhaps, a seizure of the U.S. Treasury market would be, and do you see that as a potentially likely development here.
So March the 23rd, 2020 was when the Federal Reserve marched in with its massive post-pandemic bailout. March the 20th, 2020 was a night I will never forget because the long bond quit trading in Asia. Like, just, I mean, and that's a no-no. That's a great big no-no. And there's a reason that the Treasury Department is going to come out and buy what's called, Google this, take a note, anybody, because you're going to be learning more about it in the next 2 weeks, off the run treasuries. So the Treasury Department is going to be basically pulling old, crusty, dusty, long-dated treasuries out of the market that are very illiquid to begin with. So they're going to be pulling them out of the system and replacing them with more liquid new issuance in order to try and address some of this liquidity problem. And it's, I hate to say this about, I mean, let's not give her credit because other people have been saying that this needs to be done for months now. I just think somebody finally informed Janet Yellen because the day before she said that there might be problems in the Treasury market, she also went on CNBC and said that everything was hunky-dory.
Yeah.
God love her. But the fact is the Treasury is trying to do what it can to supplement liquidity by pulling some of the worst players, some of the biggest sources of illiquidity out of this gigantic $23+ trillion market to see if it can't alleviate the liquidity issues. But I will go back to that quantitative tightening globally thing. The last time this happened in 2018, 2019, lots of things broke.
Yeah. So in other words, if things were to worsen in the Treasury market, that's one of the things that could just force Powell's hands, right?
Yes, it could, but I still say that it is likelier than not to be something that happens in credit or something that happens in another country, because we have developed economies behaving like emerging markets in prior dollar crises.
Right. Well, and technically, the U.S. dollar should not be one of the, I mean, the U.S. Treasury market should not be one of the early dominoes to fall. It should be,
The last.
in theory, the last, right?
Correct.
But it's scary that we're seeing this kind of instability there at this stage, I imagine.
It is. And again, it is reflective of the hubris of central bankers who, after the pandemic hit, you know, there was a moment in the Treasury market in early 2020, and it basically said, maybe you shouldn't try and resolve an over-indebtedness problem by creating more debt.
Yeah.
And they went, nah, forget about that.
Yeah.
Let's just go double down.
Let's just kick that can, yeah.
It's just like the central bank digital currency, right? We're going to solve a control problem by giving them more control.
Yeah, but at least I love it. Powell, when he exercises his veto power, he does it so quietly. They asked him about it again a few days ago, and he said, you know, it's at least a couple of years before we can really even get our arms around this.
Let me put a pin
Lael
in this.
Brainerd is like,
Let me put a pin in CBDCs because I've got some specific material around that in a bit. But I promise you we will get there.
Can I come back to the inflation question you asked?
Yes, you can. And I'm going to ask my closing one related to it. So in your answer,
Okay.
tackle this, which is we're all in focus on inflation right now. Totally understandable why. But you know, Danielle, you've talked to Lacey recently, right?
Yes.
So if you all know
Yesterday.
Lacey Hunt, former senior economist for the Federal Reserve, runs a highly successful bond fund. For years and years, Lacey has been warning about the deflationary crisis that this country faces. Too much debt, aging demographics. I mean, there's
none of that's changed, by the way.
none of that's changed. So what Lacey is now saying is look, the Fed has to make fighting inflation its top priority here. It's a big, serious issue. We got to get it under control. But once it does, we still have this massive deflation monster to slay, right? That we don't really know exactly how we're going to do that. So even though we're understandably so focused on inflation right now, what do you see as the bigger long-term threat here? Should we really be more worried about deflation?
Well, I was speaking to Lacey just a few days ago. He's like, Danielle, used car prices have completely round-tripped. And I'm like, yes, sir, yes, they have. And they have. And what was the single most largest driver? I think it's like 4% of the CPI. But what was the biggest driver of inflation post-pandemic? Used car prices. That's how far off the reservation they went and back. Moreover, we have, if you look at Mortgage Bankers Association weekly purchase applications, they come out every Wednesday morning at 7 a.m. Central. In half the time that it took after the housing bubble burst, 1/2 the time, we've seen an equal amount of decline in purchase applications to buy homes. And that means something very important. Fannie Mae did an extensive study and looked back at the past at how long it takes shelter inflation to manifest in the consumer price index. And that is typically 5 quarters. Very long lag time between when you see home prices rise and when you finally see it in the CPI. What were we all screaming about a year ago? Oh, that OER thing is a lie. It's a myth. Because it's under, the CPI is understating what real inflation, well, it was. By that same token, we're seeing the decline in housing manifest twice as fast as anything that we've seen in post-Great Depression history. And that means that the reversal right back out, we're at 7% year over year in shelter inflation, much higher than we ever saw during the housing boom years, much, much higher. But it also means that if we got, instead of 5 quarters, if we got this run up in real estate prices in 2.5, 3 quarters, that means it's going to back its way out of inflation just as quickly. George.
Hey, there we are.
Yay. All right.
I agree with everything she just said.
But that's what's critical, and that's what Lacey's talking about.
Right. And in some ways, we may be here in a year completely focused on deflation at that point.
Because the debt, as Lacey will tell you, and as I've learned from him, as long as we keep trying to throw money at non-productive means, it's never going to be productive. And you're just going to come out at the other end of the tunnel with a more sclerotic level of economic output.
Great. Russ, I'm going to let you follow on
No, well,
to
let's
give
hear
your
from
point.
George.
No, I'm just going to introduce this gentleman for the maybe nobody in the room who doesn't know who he is. But this is George Gammon, conspiracy theorist. Oh, I mean, critical thinker. And founder of the Rebel Capitalist and George Gammon YouTube channels. George, thanks for joining us, buddy.
Thanks. Sorry I'm late, guys.
All right. So, Russ, you had some comments there on inflation.
Well, yeah. So to me, you've got monetary policy, which is the Fed, tightening or expanding and interest rates and all that. But you also have supply and demand. And so on the demand side, you can give people money, but that doesn't create production. You want to bring inflation down, you got to increase production. And a big component of that is energy. And I think a big component of what has affected pricing has been the spike in energy. Mm-hmm. And so if we were to get back to producing a lot of energy and could bring the cost of energy down, that would mitigate some of this. So the Fed doesn't have to solve the problem all by itself. Mm-hmm. You've got government policy, which can create inflation, government spending, which is fiscal policy, which can affect inflation. You've got consumer behavior, which is, their consumer confidence and
credit card spending gone wild.
Yeah, all that. Then you've got, and the wealth effect, how wealthy they feel. People, look at this conference. It's underattended compared to past years. And I think largely that's because people are less enthusiastic and feeling less rich right now because their balance sheets are down. And, which is exactly the opposite. They should, this isn't a very exciting time as an investor, but you got to come and figure out what's going on. That's why you're all here. So congratulations to all of you. But anyway, so I think that if the economy can actually get working on being productive, then that can mitigate some of the inflation on the supply side. And then the other factor, and I'd be curious what you guys have to say. China is still on this, from what I read, on this giant, we got to eradicate every single case of COVID or even the hint of COVID and shutting production down. And we're very dependent upon that supply chain. And so the scarcity there creates, high prices. So you get the energy component, which I think has been a big part of the story. You've got the supply chain disruption, which I think that the Fed maybe thought that's what their basis of why they thought this thing was transitory. But I think you just have to look past the Fed. It's not just the Fed's responsibility to bring inflation. The government has a role to play. Government policy in terms of regulation. We went from decreasing regulation to increasing regulation. We went higher interest rates, higher cost of energy. Those are all cost inputs. And if you're out there in the real world trying to create things, you got to put all these cost inputs in and price is going to go up. Policy can reverse some of this pretty quickly if we can get better policy. in my
Right,
opinion.
that's the point. We would need to.
And I think, you know, what's interesting too is to think about it from a standpoint of a monetarist, because I've given this a lot of thought, and it is true that oil is such a massive component in pretty much every single item that we have, right? Whether it's the item itself or it's the
goes in
transportation.
everything. Nothing here got here without.
Yeah, but I
petrochemicals in some
don't
ways.
know that just because oil price goes up that you can have sustainable inflation. I think you could have 1940s type inflation, but I don't know if you could have 1970s, because at a certain point you can have what I call inflationary deflation, where the prices of the stuff you need goes up, but the prices of the stuff you want goes down. Because if you're not increasing the money supply, then you're robbing Peter to pay Paul.
Right.
And I'd be curious to.
Yeah,
could
you're
describe where we
absolutely
are
right,
right
and
now
that
as just
is that is an outgrowth of demand destruction, and we published this just yesterday, and I mean it's going to make all the inflationists' heads blow up. But if you look at, and this is something I learned from Ben Bernanke, so sorry, Mom. But if you look at the 12-month, 6-month, and 3-month run rate of inflation, you've gone, if you look at the 3-month run rate, you've gone from 11% peak to 2%, just in the space of the last 3 months, because the Fed has destroyed so much demand for discretionary goods that people are left with less to spend. We have 18 back-to-back months of inflation-adjusted lower wages. So that means that the pool of money that households have to spend on essentials means they can't spend. Now, you look at the airports that are full. I'm going to throw this out there really quickly. If you can show, and my poor husband, he's out there somewhere, but if you can show as a company that you were in any way affected by COVID, the part of the last Biden stimulus splash gives you all of your payroll tax back. Yeah. People are getting $2-3 million income tax refunds,
and
employers.
They still don't have to pay back their student loans.
They
a lot of people don't have to pay back their mortgage.
And the PPP loans were so if you're, I mean, if you're still in this kind of top echelon, you still have some money from Uncle Sam.
There's still some big stimulus
what's interesting, Adam, is I did a whiteboard video the other day where I actually looked at this. I can't remember where I got the chart, but it was basically the average checking balance for Americans based on income.
Right.
And
it's a great video, by the way.
And this was like maybe a month ago. And the average checking balance just a month ago was still over like 25% higher than it was in 2019. And so you kind of project out and say, yes, there are negative real incomes. So that's going to have to draw back down. But at the current time, they still have more money in aggregate total, more purchasing power than they did in 2019. Now, the problem there is because we've had so much inflation and negative real wages, they're going to get back down to where they were, and they're going to keep going.
They have. The saving rate is actually lower than it was in 2013.
Right. But to your point, that data caused you to push out your sort of forecasted date for the reckoning, right? In other words, you were thinking, we may see real pain in the household sooner.
Yeah, like probably 6 or 7 months ago, I predicted, I don't make many predictions, but I predicted that we'd have some disinflation.
Right.
I said maybe Q3, Q4 of this year, it looks to me like whatever inflation is at that time, it's probably going to come down a little bit. Now, it's not to say we have deflation. I'm not saying prices go down, but we go from a 9% CPI print down to 8 or 7, maybe 6. And then when I saw those numbers and that you just do some simple aggregate demand there, I'm like, well, actually, okay, now I'm going to push that forecast out to Q4 or Q1. And I still kind of maintain that.
Great. Look, I've got a ton of questions I'm dying to hear your answers to. I got 6 minutes left. So unfortunately, I'm going to have to go to the last question, which is CBDCs. I think I kind of know where you guys stand generally on this. I want you to give your answers in reaction to this clip from journalist Pedro da Costa. For those of you that don't know Pedro, he's been a journalist covering the Fed and Fed policy for the past 25 years or so for Wall Street Journal, Reuters. So he talks to these policymakers every day. I asked him about CBDCs. This is what he had to say. Can you play the clip?
Do you see the Federal Reserve issuing, or do you see the U.S. issuing a CBDC, within the next couple of years?
I don't. I think that whenever you hear the Fed officials talk about it, they talk about it as something very preliminary and theoretical, and they're always kind of working on the 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 background discussions of it, but I don't think it has any. But there's a lot of skepticism as well. Like Neil Kashkari has said, I don't understand the problem it's trying to solve, and there's a lot of. I think it's very early stages for anything material to emerge, and I'm not sure that it ever will emerge.
So,
All right,
panelists,
well, I
I'm
got
not
to
sure
ask
if you
them,
could hear
okay,
all that, but
why that?
basically, he said
Why
there's
that
a lot of
skepticism?
skepticism to it, and he's not even. Neil Kashkari says, "I'm not sure the problem that it solves." He said, "Given what I'm hearing from these guys, like I'm not sure if we're ever going to have one."
I think they need to watch my presentation from yesterday.
Yeah, I think they do too. but I'm not saying he's right. All I'm saying is he talks to the policymakers daily, and he gets the vibe that this is not a priority for them.
I mean, as long as if Jay Powell quits, then we can reopen this subject. But as long as Jay Powell's there, it's not happening.
And I think it all depends on the circumstances. I mean, if we don't have any type of black swan event or financial crisis, I'd probably agree with them.
So if they don't have a crisis to take advantage of.
Yeah, I mean, if we have another...
Except the one they're creating.
Yeah,
Yeah,
but if we had like another GFC or COVID, heaven forbid, some sort of black swan event where the whole world was ending, I think they go to that central bank digital currency pretty quick. They set up FedNow, which is basically the infrastructure for it. That's not the CBD, but that's the infrastructure for it. Yeah, I mean, that's a clearing mechanism. So from there, if they're in a crisis situation, you don't think that they would say, okay, just download the Fed app so we can get those stimulus checks to you, immediately, if that's what those Keynesians thought would save the system? I think they would. So if it stays like it is today, then I would agree with him. But again, if you have that black swan event, I think things change.
I don't see Republicans letting that happen. And after the CPI print hit a few mornings ago, predict it put north of 80% the chance of the GOP getting the House of Representatives. So
Yeah, but
they're not going to legislate in the kind of Elizabeth Warren AOC, happy dream of giving people money again directly.
Yeah, but in 2019, I wouldn't see Republicans locking you in a cage for 6 months either. They did that.
Well, yeah, yes, George. Yes, they did. All right. And you're still getting over it. Okay.
I am. I'm still pissed off at that, damn it.
Yes, Republicans will always butter their bread. Republicans are not going to butter Elizabeth Warren's bread.
All right.
It ain't happening.
Russ, anything on CBDCs?
I just think that when you talk to these guys, if you can imagine interviewing the Wizard of Oz, pay no attention to that man behind the curtain. You with me?
A little bit of misdirection, possibly?
Yeah, I'm just, I just feel like anything that gives you more control and you have the ability to implement something that gives you more control, I just think politicians, and ultimately I think the Fed is fairly political, they're going to take it. I'm just...
Not Jay Powell.
What's that?
Not Jay Powell.
I hope you're right. I mean, you know him. I don't know him.
Yep,
I just,
not Jay Powell. Because he knows that once the Fed does this, the Fed doesn't exist. The Fed disappears.
I'm just very skeptical of any political body or authority that has a great degree of control over our Main Street lives being able to restrain that power. And if the whole safety net is this one guy standing in the gap and he goes away,
Yeah, no, I mean, it's scary. I mean, we've got like 3.5 years or so the clock is ticking because somebody who would stupidly advocate for the Federal Reserve to disappear would say, sure, we'll let Treasury buy us, because that's what it is. It's a leveraged buyout of the Federal Reserve, which it ceases to exist as an independent agency once you have CBDC in place. All it is a teller to do the Treasury's bidding. That's all it is. Just hand the money out to the people, monetize it directly, and then the Federal Reserve disappears. And then we're like a socialist state, and then I have to move to like New Zealand or somewhere. Give or take.
50 seconds left. Just to your last point there, Danielle, some people say we should not have a Fed, we should have interest rates just set by the market. If I made each of you emperor and let you make the decision, Is that what you would decide, or would you have a central bank of some
Yeah, I
sort?
mean, I think this panel's the future of money, and I think listen, no money system is going to be perfect because it's going to be run by imperfect human beings in an imperfect world. Bottom line, end of story. I don't care if it's gold, Bitcoin, dollar, you name it. But I think the best bad system we can come up with is what we had in the 1800s with free banking. So where there was really no centralized government involved, there was no central bank, you know, in 1840s, 1850s. And then you just deposit your gold or your Bitcoin at the bank, and they do whatever, you know, they lever it up, they issue paper claims on it, and then you have to be very cognizant of their balance sheet. And I think that's the best bad system we can have.
So I'm not a Fed fan because I'm not a fan of centralized power. But with that said, I think that the real key is sound money. If you can't fabricate money out of thin air, if there wasn't fractional reserve banking, if there wasn't the ability to just add digits to the computer or whatever it is they do to expand and contract the money supply, there would still be the ebbs and flows of economic activity, people overinvesting, malinvesting, but it would be a lot smoother, in my opinion. So to me, if I could wave a magic wand and pick one thing, it would be sound money.
Great.
Yeah, see, I disagree. I still think fractional reserve bank is superior to full reserve, but we can talk.
We're going to have to leave
Okay,
that debate for the hallway. Danielle, I'm going to give you the last 5 seconds because we're over time here, but
I have seen what China has done to our intellectual property in a digitized, technological, modern world that we live in. I dare say I'd hate to see what they could do to our banking system if we had it not be like shepherded at all. God knows what they would do to us.
great. Thank you so much, panelists. Let's have a big round of applause.